Top 5 investing mistakes beginners make. Avoid these. Did you know that the average beginner investor loses money not because of bad markets, but because of bad decisions? Yes, that's right. It's not the market crashes or recessions that wipe out most beginners. It's the emotional reactions, the lack of patience, and those impulsive moves that end up hurting the most. Here's the thing. Investing should be simple. You buy good assets, you hold them long enough, and you let time do its magic. But the problem is, most beginners don't do that. They chase quick profits, panic during downturns, and never really learn the principles of building wealth the smart way. If you've ever wondered why your investments aren't growing as fast as you hoped, or why your portfolio keeps swinging up and down like a roller coaster, don't worry. You're not alone. By the end of this video, you'll understand the top 5 investing mistakes beginners make, and more importantly, how to avoid them, so you can start building wealth confidently and sustainably. Let's get right into it. Mistake number 1, trying to get rich quick. This one might sting a little, but it's the truth. Almost every beginner investor falls into the trap of wanting fast money. You see someone on social media bragging about turning $500 into $50,000 in crypto, or a friend telling you about a can't-miss stock that's about to explode. And suddenly, you feel like you're missing out. So you jump in, you buy at the top, the hype fades, the price drops, and you panic sell. Sound familiar? The hard truth is, there are no shortcuts in investing. There's no secret button, no guaranteed system, and definitely no overnight success. Every overnight millionaire story you see online is usually built on years, sometimes decades, of discipline and compounding. Take Warren Buffett, for example. He's worth over $100 billion today, but he made over 90% of his wealth after the age of 60. Why? Because compound interest needs time to work. His biggest secret wasn't picking the perfect stock. It was staying invested long enough for compounding to multiply his returns. Let's put this into perspective. If you invest $1,000 today and it grows at 10% per year, that's $100 profit in year 1. But if you keep reinvesting those profits, after 30 years, that $1,000 turns into over $17,000, without you adding a single extra dollar. That's the magic of time in the market. Now, compare that to someone who tries to time the market, jumping in and out based on trends. They might catch a few lucky wins, but eventually, emotions catch up. One bad trade, one panic sell, and years of growth vanish in days. The fix: instead of chasing quick money, focus on consistent investing. Set up automatic contributions every month, even small amounts like $50 or $100, into diversified funds. This method is called dollar cost averaging, and it protects you from emotional investing by keeping your contributions consistent no matter what the market's doing. It's not sexy, it's not fast, but it works. Remember, slow, steady, and disciplined wins the wealth game every single time. And if you're finding this breakdown helpful so far, do me a quick favor. Hit that like button. It helps the channel reach more people who want to learn how to grow their wealth smartly, not recklessly. Mistake number 2, not understanding what you're investing in. Let me ask you a question. Would you ever buy a car without knowing how it works, what it costs to maintain, or how fast it depreciates? Of course not. But that's exactly what many beginners do when they invest. They buy stocks, crypto, or ETFs they barely understand, just because someone told them it was a great opportunity. That's not investing. That's gambling. Real investors don't throw darts at a wall. They study, they analyze, and they understand why they're putting their money into something. Let's say you're considering investing in a company like Tesla. It's easy to get excited. It's innovative, futuristic, and led by Elon Musk. But before investing, ask yourself, how does Tesla actually make money? What's its profit margin? Who are its competitors? How much debt does it have? These questions matter Because they help you make decisions based on logic, not hype. The same applies to crypto. If you don't understand the technology, the project's purpose, or its risks, you're walking into a minefield. During the 2021 crypto boom, thousands of people invested in random tokens that promised crazy returns. When the bubble burst, most of those coins disappeared, and so did billions of dollars. The fix: before investing in anything, do your research. Read the company's financials, understand the industry, and make sure you're comfortable with the level of risk. And here's a simple rule. If you can't explain to a 10-year-old how your investment makes money, you don't understand it well enough. When you understand your investments, you stop reacting emotionally. You won't panic sell because of short-term noise. You'll stay confident because you know the long-term story. Mistake number 3: ignoring diversification. Let's talk about another rookie mistake that can destroy portfolios: putting all your eggs in one basket. You've probably heard that phrase before, but most people still ignore it. They find one company or one asset they believe in, and they go all in. Now, this can make you rich if you pick correctly, but it can also bankrupt you if you're wrong. In 2008, employees at Enron had nearly all their retirement savings invested in Enron stock. When the company collapsed, those employees lost everything: their jobs, their income, and their retirement. That's the danger of overconcentration. Diversification is your shield against uncertainty. It means spreading your investments across different assets: stocks, bonds, real estate, maybe even crypto or gold, so that one bad bet doesn't destroy your entire portfolio. Think of it like a football team. You wouldn't rely on just one superstar player to win every game. You need defense, offense, and backup players, all working together. In investing, diversification works the same way. Here's an example. Let's say you invest $10,000. You could put it all in one company like Apple, but if Apple's stock drops 30%, you lose $3,000. Or you could invest $2,000 each in 5 different companies across various sectors. Now, even if one company drops, the others help cushion the blow. If you want easy diversification, index funds and ETFs are your best friend. For example, the S&P 500 fund includes 500 major U.S. companies, meaning your money is instantly spread across multiple industries. It's a smart, low-cost way to reduce risk and still earn solid returns. The fix: aim for a mix of investments: stocks for growth, bonds for stability, real estate or REITs for income. Maybe a small slice of crypto if you can handle the volatility. That's how you build a resilient portfolio that grows over time, even when markets get rough. By the way, if you're enjoying this so far and want more practical finance videos that break down wealth building step by step, make sure to subscribe. We post weekly videos to help you master your money and achieve financial freedom faster. Mistake number 4: letting emotions control your decisions. Let's get real for a second. The hardest part of investing isn't picking stocks. It's managing your emotions. When the market is booming, everyone feels like a genius. You open your investing app, your portfolio is green, and you feel unstoppable. But the moment prices start dropping, fear kicks in. You think, what if it keeps going down? I should sell now before it's too late. That's how emotions destroy returns. There's a famous study by Dalbar showing that the average investor underperforms the market by several percentage points. Not because of bad investments, but because they buy high when things are exciting and sell low when they're scared. Let's take the 2020 market crash as an example. When COVID hit, the stock market fell nearly 30% in a single month. People panicked, sold everything, and locked in their losses. But within months, the market rebounded to record highs. Those who stayed invested not only recovered their losses, but ended up making significant profits. That's why your mindset is more important than your timing. Think of investing like planting a tree. You don't dig up the roots every time the weather changes. You plant it, water it, and let it grow, even through storms. The fix: Have a clear investment plan and stick to it. Set rules like, I invest X amount every month, no matter what. I don't sell unless my long-term goals change. If you catch yourself wanting to panic sell, pause, take a walk. Remind yourself, the market has always recovered. In over 100 years of data, every single crash was followed by a rebound and new highs. And that's why patience pays off more than panic ever will. Mistake number 5, not investing early enough. If you remember only one thing from this video, let it be this. The biggest cost in investing is the cost of waiting. Most people say, I'll start investing when I make more money. But the truth is, waiting just a few years can cost you hundreds of thousands of dollars in the long run. Let's look at two friends, Sarah and Jake. Sarah starts investing $200 a month at age 25, earning an average of 8% per year. Jake waits until he's 35 to start. Same amount, same return. By age 65, Sarah has around $600,000. Jake, only about $275,000. That's a $325,000 difference, all because Sarah started 10 years earlier. That's the power of compound growth. It's not about how much you invest. It's about how long your money has to grow. Every dollar you invest early works for you, like a tiny employee earning you money around the clock. But when you delay, you lose out on those early years of compounding, and no amount of catching up later can fully make up for that lost time. The fix: start now, even if it's just $20 a week. Automate your contributions so it happens on autopilot. And if you're paying off debt, balance it. Pay down high-interest debt while still investing a little on the side to stay consistent. Remember, it's not about perfection, it's about progress. Bonus mistake: ignoring fees and taxes. Let's throw in a bonus mistake, because this one quietly eats away at your returns without you noticing. Many beginners forget to consider investment fees and taxes. A 1% annual fee might not sound like much, but over 30 years, it can reduce your total returns by tens of thousands of dollars. Here's an example. If you invest $10,000 for 30 years at 8% annual growth, you'll end up with about $100,000. But if you pay just a 1% fee each year, your final amount drops to about $74,000. That's $26,000 gone, just from fees. The fix: use low-cost index funds or ETFs and avoid unnecessary trading. Also, use tax-advantaged accounts if available, like IRAs, 401ks, or equivalents, to reduce what you owe in taxes. Small differences like this make a huge impact over time. Recap and conclusion. Let's quickly recap what we covered today. Trying to get rich quick. Don't chase hype. Focus on time in the market, not timing the market. Not understanding what you're investing in. If you can't explain it simply, don't buy it. Ignoring diversification. Spread your risk. Don't bet everything on one stock or sector. Letting emotions take over. Stick to your plan and stay calm during volatility. Not starting early enough. Time is your greatest ally. Start now, even with small amounts. And a bonus one: watch out for fees and taxes that quietly eat into your returns. If you avoid these mistakes, you'll already be ahead of most beginner investors. Because wealth isn't built on luck. It's built on consistency, patience, and smart decision-making. You don't need to be a financial expert. You just need a plan, discipline, and time. Every great investor started as a beginner. The difference is, they learned from their mistakes early. Now it's your turn. If this video helped you, hit that like button. It tells the algorithm that this kind of financial education matters. And make sure to subscribe for more weekly videos on how to save smarter, invest better, and create real financial freedom. I'd love to hear from you too. What's the biggest investing mistake you've made or seen others make? Drop it in the comments below. Your story could help someone else avoid that same mistake. Thanks for watching, and remember, this is Finance Compass, helping you navigate your way to financial freedom, one smart decision at a time.